Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers, your Friday, January 23rd, 2026 deep dive into yesterday's market buzz.
And what a buzz it was, Ethan. Our AI analyzed a significant spike in activity, flagging over 100 posts and discussions across nearly 22 different stocks.
That's right. The sentiment is truly a mixed bag today. We've seen some serious bullish optimism around growth plays and cost-cutting measures, but also some intense caution signals.
Absolutely. While some users are making high-conviction bets, others are wrestling with significant financial risks and deeply skeptical outlooks. It means we have some really interesting candidates to break down for you.
All right, let's jump right into it. Starting with Intel, or INTC. We saw a huge amount of chatter yesterday, over 300 posts. It seems like a lot of discussion around a potential buy the dip moment after their earnings.
Well, Ethan, the data paints a very different picture. Intel's latest earnings call and Q1 guidance were frankly dismal. The projected EPS for Q1 is near zero, and their net profit margin is an incredibly low 0.37%. That indicates serious profitability struggles. And let's not forget the debt-to-equity ratio at nearly 40. We've consistently rated INTC a stay away since last September, and yesterday's news doesn't change that.
Right, so despite the volume of discussion, our AI-generated insights lean heavily bearish.
Correct. The market reaction of shares slipping over 13% after the weak Q1 guidance just validates the bearish outlook. Our verdict for Intel is stay away.
Moving on to a behemoth, Amazon, AMZN. We saw about 43 posts on this one, and the chatter around their recent layoffs was surprisingly bullish. Users are seeing these job cuts as a strategic move to boost profitability.
And for once, Ethan, I can see where the optimism is coming from, at least from a financial perspective. While controversial, layoffs do directly impact a company's earnings per share and net profit margin. Our current EPS is 7.08, and the net profit margin is a healthy 0.11. Insider buying with over 1.6 million net shares purchased in the last 6 months also signals strong internal confidence.
Exactly. Plus, analysts are raising price targets, with one going up to $315, and there's continued growth potential in AWS. These layoffs, while tough for employees, appear to be a clear cost-cutting measure that the market is rewarding.
Agreed. These actions have the clear potential to improve those profitability KPIs. Our verdict for Amazon is buy.
Next up is Broadcom, AVGO. This one generated 21 posts, and there's a lot of bullish sentiment, with users making YOLO bets and anticipating a pump hard post-earnings. Cathie Wood even added shares recently, and everyone loves their AI exposure.
Well, the AI story is certainly exciting, but let's look at the numbers, Ethan. Broadcom has an extraordinarily high debt-to-equity ratio of over 166. That's a massive amount of leverage. And while revenue growth is decent at 0.16, the price-to-earnings ratio is a whopping 68. This stock is already priced for absolute perfection, and then some. So you're saying even with the analyst optimism and AI buzz, the fundamentals are a concern? Exactly. That level of debt and valuation, even with strong expected earnings, flags it as high risk. We've rated AVGO stay away recently, and that remains our stance. Our verdict for Broadcom is stay away.
All right, let's talk Palantir, PLTR. Only 22 posts yesterday, but one user explicitly said they'd trust a meme stock like Palantir over Netflix for making money back. There's a huge upgrade and a $208 price target from some analysts, all riding that AI supercycle wave.
Ethan, that meme stock label is a red flag in itself, and our KPIs screen caution. Palantir has an astronomical price-to-earnings ratio of 385 and a price-to-book of nearly 60. This implies an almost unimaginable amount of future growth is already baked into the current price. Add to that a high beta of 1.545, meaning extreme volatility, and consistent insider selling over the last 6 months.
So even with strong revenue growth at 0.628, it's too much of a bet on the future?
Far too much. The risk of significant correction is immense if growth doesn't meet those stratospheric expectations. Our verdict for Palantir is stay away. Let's turn to Netflix, NFLX. Over 77 posts yesterday, and we're seeing some bullish YOLO bets and a lot of confidence that the stock, currently near its 52-week low, is a good entry point for a long-term recovery. Insiders are even buying heavily, over 2.4% of total shares. I understand the allure, Ethan. The underlying profitability metrics for Netflix are excellent. A return on equity of 0.428 and healthy net and operating margins around 0.24. Insider buying is also a strong signal of confidence. However, the stock is still near its 52-week low amidst a historical downtrend. And while the number varies, we have seen some analysis interpret its debt-to-equity ratio as significantly high. The PE ratio is still over 33, and the market is highly sensitive to tempered guidance.
So the fundamentals are solid, but there are some real headwinds and risks to consider.
Precisely. For investors who can stomach the volatility and monitor those financial health metrics, there's potential, but it's not without its challenges. Our verdict for Netflix is cautious buy.
JP Morgan Chase, JPM, had 16 posts yesterday. This is a blue chip, and our analysis shows strong financial health with great net and operating margins and insiders buying up over 3.7% of shares. Indeed, JPM boasts impressive net profit margins of nearly 34% and operating margins of over 42%. Their PE ratio is a very reasonable 15.17 for a company of its size and stability. While there's a headline risk with the recent lawsuit filed by President Trump, the company maintains it has no merit, and their strong financial positions suggest they can navigate it. This looks like a steady performer then, with insiders showing confidence.
It does. The fundamentals are very solid. Our verdict for JP Morgan is buy.
Now, Robinhood, Hood. We saw 42 posts yesterday, with some users making aggressive YOLO bets and strong bullish calls, even a 1,000% prediction. Plus, insiders have been massive buyers, over 77% net shares purchased. They also have a clear growth roadmap. Ethan, let's pump the brakes on the YOLO excitement here. Robinhood is an incredibly volatile stock with a beta of nearly 2.5 and a massive 52-week price range. More critically, its debt-to-equity ratio is extraordinarily high at almost 189. And while there's a growth roadmap, their current revenue growth is very low at just 1.0, which simply does not justify its sky-high PE of 44 and P/B of 11. So despite the insider confidence and aggressive user sentiment, the risk is just too great for the current growth? Far too great. The financial leverage and stretched valuation make it a precarious investment. Our verdict for Robinhood is stay away. Finally, let's talk Altimmune, ALT, with 26 posts. Users are calling it a sleeping giant in the MASH and weight loss space, with FDA breakthrough therapy designation. There's even talk of a buyout.
That's a highly speculative narrative, Ethan. Altimmune is a pre-revenue, loss-making company with a negative EPS of negative 1.07 and zero net profit margin. They have an extremely high debt-to-equity ratio of 8.569, and frankly, some of our analyzed discussions express significant skepticism about the legitimacy of the bullish claims. Funding for expensive Phase 3 trials is a huge question mark.
So, a lot of hope, but no real financial foundation yet.
Exactly. The financial risks are immense, and the future is highly uncertain. Our verdict for Altimmune is stay away.
All right, for those of you keeping score at home, here's our compiled list of today's candidates. Investigate as buy, Amazon.com Inc., AMZN, Meta Platforms Inc., META, JP Morgan Chase & Co., JMP. Investigate as cautious buy, Netflix Inc., NFLX. Investigate as speculative gamble, Robinhood Markets Inc., HOOD.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset.
Thanks for joining us on the Daily Hunt for Multibaggers. We'll be back on Monday for more market insights.
Have a great weekend and happy hunting.